Hi, and welcome to today's event where we have the pleasure to present OrderYOYO. Joining us from the company will be Jesper Johansen, CEO, and Jesper Hyveled, CFO. So Jesper is helping us to go through today's presentation. The reason for this presentation is, of course, the release of your full year 21 figures. But I think the presentation today, we will probably also look a little bit more into the future, 22, your guidance. You're maybe a little bit more focused on an M&A strategy, and of course some of the market conditions you're seeing right now. As always, ask questions down in the box down below you. We will run the presentation, and afterwards we will lift us up to the and take the questions afterwards. We will be in black while we are doing the presentation, but during the Q&A, we will again be visible on the TV screens. Do not hesitate to ask in Danish in the questions. I will, to my best of abilities, try to ask the questions and translate them. But Jesper, I think I will turn the call over to you now.
Yes, thank you. And good afternoon all. Welcome to this presentation following our release of our 21 annual report. My name is Jesper Johansen, and as Michael's saying, I'm the CEO of OrderYOYO, and I'm here with Jesper Hyveled, our CFO. Truly excited about presenting our annual report today. We have announced important news together with this report, and we're really looking forward to go through that with you at this meeting. Our agenda for today is as follows. Just briefly on our new leadership in OrderYOYO, a little bit about our strategic outlook, and then our finances for 21. I will cover the first 2 points, and Jesper will take you through our financials. Okay, let's start. And I'll start by talking about myself. As you may know, I've been involved with OrderYOYO for the last 6 years, initially as chairman, but since December 21 as interim CEO. As of today, the board has decided to appoint me as permanent CEO, something that I'm extremely proud and excited about. If some of you have seen me at the earlier investor presentations, I've been involved and present as chairman, and from now on I'll be here in the role as CEO. At the same time, Preben Damgaard will permanently take up the position as chairman, which all of us, and me in particular, are very pleased about. Now let's just step back and remind ourselves why we're here. And this is our why, this is our purpose. We want to liberate your local independent takeaway restaurant. I know we've said this before to you at these meetings, but it's very important for us to keep reminding ourselves about this. This has been our purpose since day one, and has since our foundation been very, very important, and has been increasingly important over the last years. This one is also an oldie and goodie that you would know. This is of course the most obvious reason why we help local takeaway restaurants to claim back their customers, to save the high prices paid to portals. But that's not all, because in a world with increased digital ordering, because that is increasing post-COVID, with increased manufacturing costs that you probably have read about, increased labor costs, and with increased pressure from portals, this has never been more important what we do. If the takeaway restaurants do not claim back their own customers, they will eventually be in trouble and potentially die. So this is our why, and this is why we do what we do every day. Now, this is very easy to say, but difficult to do. We have been doing this since 2015. We have from the very beginning been very focused on one specific customer segment, the quick service restaurant segment, the local independent takeaway restaurant. And we have from day one believed in focusing our efforts in selected specific geographic markets to claim market leadership. We strongly believe in local market leadership. We believe this is the key to successful European market leadership in total. Today, we're number one in Denmark, we're number one in the UK, and we are number one in Ireland. And we just entered Germany with a clear goal to become number one in that market as well. Now we see strong organic growth opportunities in the European market, all over the markets actually. But we also, and this is one of the new things that we are presenting today, we also see an increased opportunity to consolidate this market. Over the last quarters, and especially after COVID, we have seen an increased opportunity to consolidate the market. As I just mentioned, we believe in local market leadership, and consolidation is a very attractive path in that respect. Merge with local market leaders. Any consolidation that we will do will always be under our overall vision of liberating the local takeaway restaurants. So always with the same vision and goal as we currently have. Now, as a listed company, we have a clear advantage to lead this consolidation, and that's what we plan to do. We expect that the consolidation opportunity will be present within the next 12 to 36 months, and we will actively participate in this consolidation, driving it. To prepare ourselves for this consolidation, we have decided to strengthen our capital base with a total of additionally 80 million Danish kroner. This is not because we necessarily will pay with cash in a consolidation, but to ensure that we have adequate capital resources to be able to execute on the right actions after a merger or an acquisition, to be able to do the right thing. Now, the 80 million is divided between 40 million in equity and 40 million in debt, all provided by strong shareholders and our long-term loan provider, Vækstfonden. And then just before I give the word to Jesper to take us through our numbers, just very high level, our realized financial versus our latest guidance. Annual recurring revenue of 120 million. We guided of ARR of 110 to 125. Net revenue 108.5 million versus a guidance of 102.5 to 107.5. So slightly above. EBITDA of 0.7 million, and we guided around a 0 at that point. And GMV, gross merchandise value, of 1.2 billion versus 1.1 to 1.4 billion guided. So that was the overall financials. I'll give the word to the other Jesper, who will take us through the detailed financials. Jesper, here you go.
Thank you very much, and hello everybody. So let's start out with our net revenue and gross margin. In 2021, we have achieved a 42% growth compared to 2020. The growth has been established with organic growth and continues the year-over-year growth we have achieved since 2017, illustrated here by a 12 times higher revenue in 2021 compared to our base year of 2017 of 9 million DKK. Our gross margin 2021 was 85%. That's comparable to 2021, where it landed on 84%. Looking a little bit into our annual recurring revenue, we had a growth of 15% compared to 2020. I think what's important to mention here is that despite the COVID-19 restriction tailwind that we saw in December 2020, we grew 18% in our ARR December 21 without having any COVID restriction tailwind. Again, this continues the growth we've seen since 2017, where we have seen a tremendously higher growth in 2020 compared to previous years due to the tailwind that I just mentioned based on COVID restrictions. As a side note here, the 120 million ARR is an all-time high for OrderYOYO and something that sets a milestone and something we're very proud of, and we will continue to grow upon. Taking a dip further into the annual recurring revenue, what we are trying to illustrate here on this chart is that we also grow ARR in a normalized post-COVID business environment. We try to illustrate this here by showing you quarter year over year, where we have identified 3 quarters here, Q2 to Q4 in 2021 compared to 2020, where the 2020 quarters all have tailwind from restrictions of in relation to COVID. Despite that, we still saw double-digit growth in the following years in the comparison quarters. We believe this illustrates that our business model is successful and that we can grow together with our restaurant partners, and that we will continue with going forward. Now, our EBITDA normalized. Here, it's important to mention that this EBITDA is the EBITDA that we guide upon. It's based on our primary activities. So this is before other expenses and other staff costs, mainly related to the IPO. We landed, as Jesper just mentioned, as we guided, around 0 with a positive of 0.7 million DKK. 2021 was a year of heavy investment. So we invested heavily in both our platform software and in growing our restaurant partners. We have invested in our platform with open eyes to ensure continuous future growth. This is also visible when we take a look into our cash flow and the impact that this investment has shown on the cash flow negatively, obviously, but it's done on purpose, and it's because we believe that will help us to future growth. Finally, we've invested more in our restaurant partners by increasing our common marketing efforts, again with one purpose: to drive future growth for OrderYOYO as well for our restaurant partners. Future growth for our restaurant partners is key for future growth for OrderYOYO as a whole. And we have been successful with that journey in 2021, something we will continue in 2022. Now, that was what we had about the numbers of 2021. Taking a look into our guidance for 2022, we have maintained our guidance that we shared earlier in 2021. The 2022 guidance of net revenue is in the range of 120 to 135 million DKK. That's equivalent to a growth between 11% and 25%. We have an ARR in the range between 140 and 170 million DKK. That's equivalent to a growth between 17 and 42%. We have an EBITDA in the range between 5 and 15 million. Again, this is due to the fact that we are going to invest in our restaurant partners, and we will keep on investing in our future growth. Finally, we have a GMV guided between 1.4 and 1.7 billion DKK. That's equivalent to a growth of 19 to 44%. Finally, what I'd like to state here regarding the 2022 guidance is that the guidance assumption is solely based on organic growth assumptions, with growth coming from both new and existing restaurant partners. That was what we had. So I think now we're going to turn on the camera and open for Q&A.
Yeah, can you press the red down there? Yeah.
There we are.
Perfect, Jesper, and Jesper, I must say. I think I would like, just before we turn to the questions from the audience, I would like to turn a little bit. I know it's not a new strategic. You always said that you wanted to use M&A in your forward growing, but it seems like it moves a little bit more in the forefront of your strategy. You're picking up money to do this. Is this we are looking at Flip this getting some money from Tencent, and I would wonder, are you seeing more prospect? Do you have a list of candidates, and are this move by Flip this maybe and the changes in the market, is that something that brings that on board? I guess maybe people are seeing it's nice to be part of something bigger because of this. I don't know whether you can elaborate a little bit. I know there was a lot of questions, but let's take it.
Yeah, no, let's see if I forgot to answer, then ask again, and if I still don't answer, it's because I don't want to, but I'll try as good as I can. We do see more consolidation activities and more prospects in the market right now, as we did actually during COVID and before COVID. I think a couple of things have kind of triggered that. I definitely think that the big round that Flipdish did, taking in $100 million from Tencent, the Chinese investment conglomerate, has been something where people kind of said, okay, what happened and what are we going to do? I also think that and they have actively said that they are kind of looking into consolidating and doing these kind of things as well. I think that we as a listed company do have an easier path towards consolidation, in the sense that we can use our share much more actively than they can. I think that you probably all, well, I don't know, but you know, Michael, the valuation of Flipdish is somewhat high compared to us. I think they're trading at 50 times ARR, which obviously is good for a company when you're raising money. But if you want to buy or consolidate or merge with another company, it's going to be difficult to do that by paying in shares, because there's not a lot of the interesting target consolidation partners that will be very interested in receiving these shares, because they are so high priced. So you will, as a target, be paid too little for your company, basically. That is something that talks to our way of doing it. I think that our approach with a listed company with a valuation that's much more fair has a big opportunity to do this. But I think that is a part of a movement where we are seeing all of us kind of saying, okay, we need to do something here. That combined with the fact that I think that during COVID, everybody was super busy, so nobody could actually look outside their own nose, or whatever it's called in English. Don't know what that's called in English. But that's kind of evolving on the other side of COVID. And what we have seen is a lot of market players that, I mean, as you all know, we've been through a recalibration. Kind of the market were, especially in the UK, were difficult. But we have all through this process been relatively focused on our overall vision of who do we sell to. Now, not all has been that, basically. So there are companies out there that need to do something right now, also from a business point of view, and consolidation is part of that. And then the last thing is that I think that where this was a fairly blue ocean market 5-6 years ago, you have seen local market leaders emerging here and there. And actually the opportunity, since we are very focused on specific markets where we are taking market leadership, it's fairly easy for us to go in and approach some of these local market leaders, because the merger in such a case is a very positive merger. It's about creating Fortress Europe, which is actually our strategy. So I think there's a lot of stuff that has been going on over the last 6-9 months, and that I think will carry on and will emerge over the next 12 to 36 months. And that's why we very publicly want to state this. Obviously, I cannot comment on any discussions we're having, but of course we see more activity in this market than we did 6 months ago, also since we're doing this. In terms of our capital and capital increase, we actually believe that I think there are two sets of potential merger candidates or acquisition targets here. One is the local market leaders. Those companies I would actually like to merge with for shares. And the reason is obviously that in these local market leaders, you have very strong managers and leaders sitting there that you want to keep involved in the business going forward. They're important for the business. You do that by paying with shares and not with cash. If you buy small bolt-on acquisitions, you can do it for cash, because that's a matter of integrating much more than kind of taking big market shares. So the capital increase that we're doing now, as I told, is more about getting ready for doing the right thing after a merger, because there's a lot of integration. We need to work on different stuff when you do these kind of things. You can't take that easy, and you want to be able to do the right thing at the right moment. And sometimes that actually costs money, and that's basically what we're preparing ourselves for. Was that answer enough?
Yeah, I think that was a very good answer. Yes, but there is a little bit. Are you looking after acquisition in existing market, meaning Germany, UK, Ireland, Denmark, or are you also looking for a market leader maybe outside these existing markets? So just so we get that defined.
We definitely do mainly outside our markets, you could say, outside our current markets, especially the ones who are your market leaders. I mean, as you all know, we entered Germany last year through actually a small acquisition, Hubs, that actually has learned us a lot. But still, it's less than 100 restaurants, so fairly small. So in that sense, we could also look at Germany, and then we will look at other markets. Actually, the current markets, so Denmark, Ireland, and UK, will probably not be our initial focus area for emerging. We actually want to take market leadership in some of the other European markets. Only Europe we're looking at.
And maybe there's also there's a technology. Is it customers or technology? Perhaps was, I think, more technology and get a market entrance. So how will you are more now going outside those markets to get a head start?
How should we look at it? I think the hedging answer is it's all. Right, so we do both, but obviously the merging with local market leaders is predominantly about customers, about taking market leadership, market positions. Now, when you do that, obviously a lot of these companies are 4, 5, 6, 7 years old, so there's definitely also a lot of interesting technology in these companies that we will have into the combined group that we will use across the whole group. If we see specific technology that are interesting for us, we would acquire that as well. That would probably be more of an M&A, an acquisition strategy than a merger strategy. So when we do merge, it will be basically customer and market leadership we go for.
And then there's a little bit about the British market. I can see in your figures, or I can see in the ARR that it is again growing on existing customers. You also seem a little bit more optimistic about the market in the UK. Maybe two-part questions. How are you looking into it? Is it you who are doing better at fighting with those worst market conditions, or is it are the market conditions getting a little bit better? So you both get a little bit help from the market, but also from your performance over there, helping your clients survive and strive.
I think a month ago I probably said that it's both. I think that the market condition has improved. We do see for some of our restaurants and our restaurant partners, additional difficulties in terms of manufacturing cost, labor cost, and all these kind of things. But we're much more prepared for it now because we are, and this is what we did 6 months ago, as you all know. This is a process where we kind of recalibrated and increased our focus on helping our restaurant partners even more than we did. It has been more difficult, especially in the UK, than it was during COVID, of course. And that's just, this is why actually I spent some time on our why, our purpose, because this is actually what we have fantastic employees, and that's what they do. We actually all feel a very big passion and see the purpose of what we're doing, of helping these independent takeaway restaurants. And probably after COVID, we can see that we are needed even more. So we are fighting more for them and are spending also more money, much more, not much more, but more money on helping helping our restaurant partners. So I think it's both.
And there's actually a question. I jumped to that. I will make sure, Fan. Does a substantial share of the net revenue growth here and lately consist of buying Google ads to your RPs, getting them out in the public? You are using some money. You talked about you increased your marketing spend to help your restaurant partners. Yeah. So it's a little bit, has that been the driving force, meaning it's pushing up your cost, also driving up those? So there's a question here.
Yeah, no, actually, I think that's one channel. I think that Google is not only about ads, about actually, I think one of the most important drivers that we are focused on is actually, I think we've talked about this as well before, is GMB, Google My Business, which is the right hand side of a search page from Google, where basically the restaurants own storefront on Google is present. Now, claiming the Google My Business in the restaurant's name is something that we are focused on to the extreme. I mean, and this is actually something that's cost-free from a marketing point of view, but it's a big hassle to do because it's a fairly, compared to we're talking about Google here, it's a fairly manual process to do that, involving real postcards being sent with codes and stuff like that to the restaurant. So that's another part that's driving traffic a lot. We're doing some interesting stuff on other parts of Google as well. We're doing stuff to convert the phone orders, and we do text, emails, and stuff like that as well. Google Ads is definitely a big part of our business, but it's actually it's not the only driver of this.
It's not the only.
It's important for us to be. It's important for us to be on all platforms and all channels for the restaurants.
So it is. I think the question is substantial part. Is that what has driven your turnaround entirely? If I should read the question, and you are saying no, there's other stuff you have done to increase your restaurant partners' revenue and GMV, and thereby your revenue.
Yeah, I think it's important to say that it also indirectly grow our ARR, because it grows our top line when it comes to commission as well, because we can grow GMV. And it's difficult again to compare against 2020, because 2020 was a tailwind month when it comes to ARR in December. So we cannot compare it one to one. But compared to 2020, yes, a part of it comes from Google, but also indirectly by growing existing customers.
And then I have a question here. The reason behind that your revenue growth in 21 was higher than your ARR growth, but if you look at the guidance, the picture is different. Is that a part of your which quarters the things will fall in, or how should we understand that flip between 21 and 22, looking at the growth rates for revenue and ARR?
Yeah, again, it's very much due to COVID. So in some of the early months in 2021, we also were impacted by COVID, which was not the case. We do not expect that to be the case in 2022. So if you look at net revenue growth compared to 2020, that's a big chunk of the growth here year over year. And then again, we actually do see that the growth in our ARR is quite positive in 2022 compared to 2021.
And then there's a question here. You've shown the cohorts, really nicely growing your current customers from 17 to 18 to 19 to 20. And then this year, if we looked into the cohorts of customers coming in that year, actually saw a little bit of a dip in all of your cohorts. So there's a question here. Was it temporarily headwinds, COVID and the situation in UK, or is there something we should expect going forward? If you can comment a little bit on that. Do we want to change that picture we have seen here in 21 on the cohort side?
I think this has very much to do with the COVID effect. So that's basically why you from December 2020, where we had a lot of tailwind from COVID, compared to December 21, where there's no COVID effect, where you see it as a slight dip in all the different cohorts, and the growth from ARR is then basically coming from additional RPs in 21. I think this is where we are different than normal SaaS companies, since we are based on a usage-based subscription model. So we get paid not on a fixed fee, but on a commission. We grow with and also for with our restaurant partners. And basically what the chart shows is actually that our different partners have actually seen slightly falling GMV from December 20 to December 21. Now you can actually also see that in another slide in our annual report, and we haven't brought it here because it's super messy and super busy. It's the one with basically where you see the MRR churn quarter over quarter on our business, because what you see there is actually you see a lot of seasonality in our ARR. You see that a lot of our uptake is coming from new RPs, And then you see that our MRR churn is relatively low, which basically means that once a restaurant is onboarded and is onboarded successfully, they seldom churn. I think we have ARR churn of around 4%. So the dip is not because of churn, it's because of slower activity, because of seasonality and because of COVID.
And then there's a question here. You did a big cleanup of partners in September that removed some inactive RPs, restaurant partners from the platform. Have you done any of those cleanups since then, and having to churn a big chunk of your partners? I guess when we do the churn and it's still low, it must mean that it was inactive or they didn't put that much revenue.
Yeah, I mean the churns that we have done in terms of restaurants, I actually think that a lot of these were actually churned, if I remember right, during January, actually this year, January and February. So they weren't churned, all of them in September. But the thing is that those restaurants were basically they basically had no GMV, so they did not, cost us anything. So the effect on our MRR is zero, basically.
So and the question here is, are you still doing Sorry, and the question is, are you still doing those cleanups, or was that a one-time?
We do that all the time. We do that all the time. I mean, we have to. This is one area that's important for us. We need to obviously it's not it's not super interesting for us to do a sale to a restaurant and then we have to churn the restaurant because they do not fit, or for whatever reason there's no GMV through that restaurant. So we need to minimize that because it's costly to have these inactive restaurants. So we want to keep that churn down, but for us that's actually it's not churn, it's more a matter of selling to the right restaurant and make sure that the sales process and the onboarding process is effective. So if we sell to the right restaurants, we should be able to get them running so that they don't churn. Now if that for some reason, and that can be both on our side and on the restaurant side, that the restaurants do not kind of get going, it's better for us to get them out of our system and not spend more time on it, because time spent on inactive restaurants that do not work in our system takes time from working with restaurants that actually do work, where you can add a lot of value. So for us, this is a matter of making sure that as everybody else, resources for us is limited, right? We only have the number of employees and the resources available 24 hours a day. So when the hour is spent, we can't spend it again. So we want to make sure that all our strong employees are using their time as valuable and value creating as possible. And one way of doing that is to make sure that they don't spend time on restaurants that do not work. Now that's not the same as saying that we want to keep that going on, because it's not fun to have that. But that's another part of the story.
And maybe we could give on that, and I don't know whether you give the number or don't give it. How many new restaurant partners have you gotten in 22 approximately? If you look away from a cleanup or deducted churn.
In 22, I mean, actually.
Sorry, gotten in 22. Yeah, I guess it's 22. So we get a picture of. I know you are maybe not allowed to tell it.
Yeah, the last couple of months, I think we are at more or less the same run rate as we was in the last 2 quarters of 21. We do not guide on that specifically, but around 100 would probably be a good guess, I would say.
And then the next question also touched a little bit about that. Did you have a net uptake in partners last month? And I now know we are looking forward, so let's see if you want to.
Last month in February. Can you say that?
We generally expect and anticipate positive growth every month on restaurant partners. Whether or not it falls within 1 month or another, it's I think that's too sensitive to say here. But we do expect and have ambitious growth rate also on RPs, but it's not something we think is important. As Jesper mentioned, what's important for us here is the right restaurant partners, not so much how many of them, as long as we get the right ones in.
And then should we expect a higher revenue then 22 guidance if you acquire customers. You know, I guess it will depend on a lot, but I guess the other way around, you haven't included any acquisition in the current guidance. So if you buy something and early enough, yeah. So that it's a clear cut. You haven't included any M&A in your current guidance.
Correct.
Perfect. So if you buy something and there's customers, they have revenue and it's timely enough.
Yeah.
When do you expect to have steady sales in Germany, like you have in the other markets? You know, you elaborated a little bit on it, that you have taken on new restaurant partners down there. So maybe if you
we're yeah, early days. So when we would be ready to have a position like the one that we have in the UK market? I mean, I think that building up an organization as the one we have in the UK, which I assume is when we say the other markets, because you know Denmark is obviously a fairly small market compared to the German and the UK market. So building up an organization as we have in the UK with some 70 people, it does take time. So we will build that, you know, steadily over the year. Whether the organization will be able to be able to have the size and the ability to take in as many RPs as they have in the UK right now, whether that will happen in Q4 or during 23 is difficult to say. That depends very much on how many people we can attract, because I mean we need to build an organization of you know a fairly big size to be able to do that.
Perfect. And then there's
we're scaling up all the time.
You're scaling up down there, so that is the yes. How many RPs have you moved to the newer platform version? Yeah, I guess you have developed a lot of a newer platform.
It's the PVA version. I think everybody's moved now. There's a few that's still for technical reasons are on the old platform, but basically everything is moved. And I assume that then the following question will be how many churned during that process, and nobody churned because of that. We this is actually one of the things that we are very proud of the tech team, that you know the ability to transform and migrate that many restaurants to the new platform has been very strong, and has been done without losing anything. So,
and then I have a question here, probably for Jesper, the CFO. How come ARR grew while GMV, gross merchant value, decreased? And I'm not sure your GMV decreased. I don't know whether it's a quarter here, but maybe you can elaborate a little bit on it.
Yeah, I can for sure. Well, that's partly due to two things. The main reason is actually our commission model. So by having revenue spread across our restaurant partners within the range that we have on our commission version, like the one Jesper showed, between 5 and 9%, minor restaurants might go with a higher commission rate due to lower sales, and that's basically why we can maintain growth in ARR despite a slightly decrease in our GMV. On top of that, of course, we also have additional revenue streams that we can add, and we are adding, which is basically investing in future growth.
And then there's a question. Yeah, and then there's a question here. Why did you remove the restaurant partners by market graph from report? Is there any reason less you want to focus less on it?
Yeah, it's actually we actually and this is a new way of thinking for us. For us, it's number of restaurant partners is obviously interesting, but it's only interesting if these restaurant partners are active and are working and are performing. So the number of restaurants are not in itself a metric for us. It's all the underlying stuff that's important for us. So the GMV, so the ARR, so the additional growth and all these kind of things. And that's what we're focusing on instead of focusing on the number of RPs. It's actually, and I think we've talked about this before, it's actually pretty easy to get a lot of RPs. And the difficult thing is to get them running. So in order for us not to focus on that specific number, but focus on the financial value of an RP, we get our organization and all of us to think much more about the value creation instead of just adding one more RP.
Perfect. And then I
So
think we have
it's a
one
mindset thing.
more. Yeah, it's a mindset. Also wanted to show that to DS. There's a question here. Could you give a hint on how big a part of external cost consists of purchasing Google Ads to your RPs? 50, 90%. If I don't know how deep you want to go to this, but there's a question.
We can't go that specific into to that split, but what I can say is that, as also mentioned in the annual report, is that it's larger normally than in 2020, and we are investing more than we did before. But this year we cannot share. But it's a good question.
Yeah, well, and I think we have. Maybe I can get a last question, and then I will leave both you and Jesper to go on with your job. We are listening to inflation, and you mentioned it yourself. Your restaurant partners are pressured by inflation. It should also mean that they need probably to raise their prices in the future. And you are a percentage-wise GMV business driven. How should we think about that? I guess you might have a competitive edge because your percent is lower, or will you try and protect your customers if they need to raise prices solely because of inflation and not them earning more money? Just a little bit of elaboration on, does it make you more competitive against the higher ones because now it really is rising up prices, but also do you need to protect your customers a little bit by lowering your percentage?
I think that we do not expect to lower our percentage, to kind of start there. But what we can do is, and there was this question about Google Ads and stuff like that before. Obviously, we have our restaurant partners; they invest in that themselves. But so instead of lowering prices, I would much rather actually say to a restaurant, I know that you have increased prices, but let me help you to take part of what you pay now and invest for you, because that will benefit both him or her and us. So instead of decreasing prices, we will probably invest more together with the restaurants. We would rather do that than anything else. In terms of competitive positioning, I think that is just another reason for restaurants to have their own white label provider and their own system to claim back their customers and not be on the portals, because of course, increasingly they whether they can put on all the costs to the specific end users or not, who knows, for inflation, but of course, with increased manufacturing prices and all those kind of cost of goods sold that they have, and a 30% portal payment, it's going to be difficult to be a restaurant. It's just going to be. So they need to do something, and we're obviously the right choice, right?
Perfect. I think we went on through the questions, also mine. Thank you to you, Jesper, and thank you to a lot of good questions. Some of them wanting to dig a little bit, maybe too deep into your reporting, but nobody doesn't get anything if they don't ask. So thank you a lot also for the audience side, and have a nice day to all.
Thank you.
Thank you.
Thank you for listening. Bye-bye.